Thanks for joining us tonight. My name's Nikki Morsink. I'm the Head of Investment for Enable Me. And tonight we're going to do just a really high level overview on the fundamentals of investing in managed funds. So as always, this presentation is informational only and doesn't constitute individual financial advice. So what are we going to cover tonight? We're just going to touch on the investment landscape. We're going to talk about what a managed fund is. We'll touch on the benefits, how they can fit into your overall financial strategy, the risks, how do you buy one, and what's the benefit of using a financial advisor. So why bother talking about managed funds at all? So when it comes to any investment decision that you need to make, you always need to start with the end in mind. Where are you now? Where do you want to be? What's the age? What's the gap? How long have you got to get there? And when you have thought about the investment decision you're trying to make in that context, it's going to get a lot easier. So the investment landscape, it has never been easier to make an investment in New Zealand than it is today. You have got multiple options. You've got different asset types that you can choose from. You might use property, there's KiwiSaver, there's cash at the bank, there's shares, managed funds, and the latter two you can actually really shop around and get into from the comfort of your own couch using an app on your phone. The tricky part is not how do you buy your investments? The tricky part is what should you be buying and for what purpose, and how is it going to fit into your overall financial strategy? So when you're thinking that through, you've always got to consider, like I've said, the end goal, the time frame, what is your current assets? What's your risk appetite? How much risk are you going to be comfortable with when you've got headwinds and it's getting a bit choppy out there? You want to be able to sleep at night. How much risk is required for you to bridge the gap that you're looking to bridge as you build your wealth going for the future? And it's always good to have a bit of knowledge. So you don't want to be sort of throwing darts at a board. You want to be thinking about what asset type is going to really meet my needs. And then once you know the asset type, there's going to be choices within that bracket to consider. Like I said, when you've got the baseline thinking done, it all gets easier. So us Kiwis have got a fairly low uptake when it comes to using managed funds as part of our overall wealth building strategy. So according to a study done by the FMA, only about 13% of us are using managed funds as part of our strategy, and couldn't help but think that's a really low number. And really, when I was considering why, I think it might be that there's a lot of jargon around mutual funds. I think they can seem difficult. They're really not. And even if you've decided that you would like to use a mutual fund or a managed fund, how do you choose amongst the multiple choices out there? There's about 700 on the market, probably more. How do you decide which one's best for you and your plan? So I suspect that really this has created a lot of paralysis by analysis. And as a result, people just put it in the too hard basket and probably don't get around to it. So I'm hoping we can change that a little bit tonight. When it comes to KiwiSaver, however, us Kiwis are doing better. So 63% of us are in KiwiSaver, which is fantastic. And what I particularly like about this is that your KiwiSaver happens to be a managed fund. So there's quite a few things that KiwiSaver have brought to the table, but one of the ones that I particularly love is that it has normalised the use of managed funds for us everyday Kiwis. You've got used to what it's like to have one, to save into it. You know a little bit about whether yours is defensive or whether it's like growth focused. You've had a chance to see what that's like when you get different headwinds in the economies out there. So when the sun is shining and when the rain is coming down, you've seen how your KiwiSaver responds. So it's kind of normalized that. You've now got some experience with that. And I would hope that as a result, managed funds don't seem so foreign. I'm also particularly pleased that our young people are getting exposure to managed funds in this way. It's normalizing it and making them aware of the fact that they have this tool that they can use when they're trying to grow wealth for their future. So while we're talking about KiwiSavers, there's a couple of other things I'd like to point out. It still makes really good sense to have KiwiSaver as part of your overall wealth building strategy, mainly because of some of the goodies it brings. So you get employer contributions and you get government tax credits. You definitely want to clip those tickets. They are, however, less liquid than a private managed portfolio could be that was sitting alongside your KiwiSaver. And what I mean by that is there's no government control around a managed fund that you own on your own. So with the KiwiSaver, you can't access it unless it's for a first home purchase, possibly a second, or when you're 65. So it's not very liquid or available to you should other things in life happen that you might want to access your investments for. A privately owned managed portfolio, on the other hand, you have no government control around it. So no one can tell you when you can and can't take money from it. They're quite liquid. You can decide your own contribution rate. You can change that contribution rate because something's changed in your life and maybe you're not able to save as much as you thought you were. So it's just really flexible. So I would suggest that you contribute what you need to your KiwiSaver to clip the ticket on the employer contributions and the tax credits. But for funds that you might be considering investing over and above that, I would be looking to a privately owned managed portfolio. So let's talk about what a managed fund is. So at the highest level, it's a way that you can invest funds, and it can be as little really as you can afford, and immediately you get access to a whole range of different types of assets. And then when you're doing that, your money is pulled together with other investors, which allows for much greater buying power and access to investment opportunities that you may or just wouldn't have access to as an individual investor. And then just to top it off there, you've got a fund manager who's overlooking the whole thing. They'll be working to like a management strategy, which would be outlined on the information that came with any portfolio or managed fund that you're using, including your KiwiSaver, by the way. And they're doing all the heavy lifting. So they're making the decisions on what to invest, where and when. In my opinion, and this is something I just wanted to bring up because I think it's overlooked, right? I actually think that managed funds are truly one of the greatest advancements in the investment world, because what it did is it brought mutual funds, or it brought access to global stock markets to normal everyday investors like you and me and our kids. So if you think about it, before managed funds really came into play and they became popular in the 1950s, if you wanted to invest in stock markets and you wanted to replicate anything like you get access to via a managed fund, you would have to pop down to your stockbroker and then you would have to purchase up to 10,000 positions, different shares and bonds. Maybe you'd pick them, maybe your stockbroker would pick them. That's another whole can of worms. And then even if you did manage to do all of that, you then have to think about how you're going to manage all of the foreign exchange palaver, really, that comes with owning stocks in international markets. Now, people used to do this back before the 1950s, but really it was only people that had the wealth to do it. So we didn't always have access to amazing investments like these. And I think it's just something that we forget about because it's just something we see every day on our phones, on our computers. So, but really, They're amazing, and we shouldn't underestimate the gateway they give us to investing in international markets. So what are the benefits of managed funds? So we've already touched on it. First of all, it gives you access to a really wide spread of investments that would be hard to replicate if you were just trying to piecemeal it together yourself. It gives you access to a greater mix of assets. And this is important because it means that you're less exposed to the performance fluctuations of individual shares. So you've got diversification, really would be another way of putting this. And you get diversification on different levels. You get diversification on asset type. So you've got your mixture of your bonds, your shares, your cash. Sometimes there are derivatives thereof, but we won't get into that today. But you've also got geographical diversification, which is really important. And if you look at this slide, this basically shows you the relative size of the global share market as at 2019. And if you can see the tiny little line that the blue arrow is pointing to, you can see that New Zealand represents a tiny sliver of global market shares. So if you think about it, if you were just out there stock picking in New Zealand and you were to put, a large allocation of your wealth to that, you are making a really big bet on a very small part of the global markets. In a well-diversified managed fund, you're going to get not only asset type diversification, you're going to get geographical diversification. These are both good things. And you've got experts on your side doing all the heavy lifting, which is always good, because really, once you've got your investment plan in play or your wealth building strategy, you really want to get on with your life. So another advantage is that they have low entry points. So you don't always need thousands of dollars to get started in a managed fund. There was a time when you did. There was a time when you had to have $5,000 or $10,000 or $15,000 to be able to access a managed fund. That's not the case anymore. They're all different, but there are several out there that you could access with a zero balance and just be able to save into it regularly at a level that fits your budget. Really, really accessible. And as I mentioned when I was talking about KiwiSavers, they're really liquid. They're very easy to get your money in and out of. Again, every managed fund sort of has its own details, if you like, that come on a fact sheet. However, I would say as a rule, you should be able to get money out within 10 working days of most of them. And it could be that you are withdrawing a small amount because something's happened in your life and you suddenly need to cover the cost of it. Or it could be that you want to, for some reason, liquidate the whole fund, and that would be the same. The whole thing would be back in your bank account at the value, obviously, that it recorded at the day you did that, within 10 working days. So they're really liquid, and this makes them quite flexible. Another great aspect of a managed fund is that you get to control your risk exposure, which is no small thing. So if you've ever dabbled with managed funds, or if you've looked at the information that supports your KiwiSaver, which is also a managed fund, you'll be familiar with this risk scale. And it's there to give you an idea of the risk of the exact portfolio or managed fund that you're looking at. And you can, and it's there to help you consider if it's right for you and if it's right for your overall plan. So obviously, if you go towards high risk, which is a 7, that just means that you've got more exposure to shares, which is commonly referred to as growth exposure. And at the other end of the scale, where it says low risk, that is having higher portions of defensive assets in that particular managed fund, and that would be cash and bonds. So the higher the risk, I guess over the long term, we would expect higher returns, but it's going to be a bumpier ride. And the lower the risk over the longer term, we would expect lower returns, but it's going to be a smoother ride. So in this slide here, it's another way of looking at the same thing. So we're talking about risk exposure. So these numbers came from Sorted, and what they tell you is average returns based on 5 years of data after fees and tax. And you can see that if we look at the growth fund, and in this example, that growth fund's got 80% growth exposure, 20% defensive. Now, the returns expected over that 5-year period on that fund were 9.3%. And if you go to the conservative fund, you can see that it's 3.5. So a bit of a difference between the two. And like I said, the higher returns come at the cost of more volatility, which just means that the value of your fund, when it swings high, it'll swing higher than a conservative fund. And when it swings low, it's going to swing lower. There's no absolute right or wrong answer when it comes to this. This has to be considered in the context of your specific situation. First and foremost, you've got to be emotionally comfortable, which means if we're having volatile markets, it's important that you can still sleep at night. And then also we want to sort of check that whatever fund is being used to, I guess, meet your or solve your problem, we want to make sure there's enough risk on it that it's going to do what we want it to do in the time frame that you want it to do it. So it's a mixture of how much risk should you take. It should only ever be as much as you need to for your circumstance. So when you get returns from a managed fund, what are they? So it's going to be a mixture of interest from the bonds in your managed fund. It's going to be dividends from the shares that you hold in your managed fund, and it'll be the capital gains earned by both of those asset types, and from time to time losses. But your portfolio return gets reported to you in your regular reporting. So I'm sure you've seen that on KiwiSaver. It's the same on a private managed fund. And each period it gets reported, you will see in total what the collection of those different points of return have added up to. So you'll get a percentage of return. Now, generally, there are different ways. I mean, sometimes you can have, returns that are put back into your account as they are earned. But generally, the way to go is to have them just reinvested into the portfolio so that the returns are growing on the returns and therefore building up to the sort of wealth target that you're looking for. So how does a managed fund fit into your investment strategy? So they're a great addition to a financial strategy because basically it gets your money working harder for you, but while still remaining liquid. They require little hands-on work from you beyond the initial selection of the appropriate funds as dictated really by what you were trying to achieve. And they're really easy to adapt should things in life happen that you weren't expecting. So, you can save less into them, you can save more into them, you can make withdrawals when you need to, you could turn regular contributions off altogether for a while if you wanted. They're just a flexible option of making your money work while not losing total access to it. Also, incidentally, in terms of rising inflation, like we are right now, they're an effective defensive strategy as opposed to having your cash in your bank. So what are the risks? As with any asset really that you buy as part of, to get a return as part of a wealth building strategy, the main risk is that the fund can drop in value, and they do from time to time, but that shouldn't scare you, because what history has told us is that if you can weather the storm, there's a high chance that you're going to come out on top at the other end. So this chart shows us the difference in returns between shares in large companies, shares in small companies, in government bonds, and trying to read the small writing myself, and in residential property, treasury bills, and there's an inflation line running across the bottom. But as you can see, if that chart's going from 1926 all the way up to 2021, and despite major hurdles like world wars, recessions, oil shocks, markets have rewarded the long-term investor. So once someone has sort of thought that through, decided it's a good option, and think they know where they're going, the next question that normally hits is, when is a good time to invest? When should I start? So the way that I look at this is that whether you see this glass as half full or half empty, you've still got to take a drink. And it's the same when you're thinking about, when should I start investing, you know, for my financial future? There is literally no best time to get started apart from now. If you think, I don't know, you could sort of think, well, you're waiting for perfect conditions or for markets to be a certain way. For one, I don't know how you would ever actually know when that perfect position was. And what I can tell you is quite likely is that while you're sitting there trying to figure that out, you're probably going to miss out on great opportunities. So when you're looking to invest for the longer term, and by that I mean 5 years plus really, the time to start investing is always now. And it doesn't matter if you're asking me that today, if you asked me that 6 months ago, or you asked me that 6 months from today, I'm going to give you the same answer. The answer is now. It's not timing markets that makes wealth. And anyone who tries to convince you otherwise, I would suggest, is having a bit of a yarn. It's time in the markets that count. So you want to get your plan together, make the choices, and crack on. Yeah, time in the markets, that's what matters. And if you're not sure about that, I'm just going to take you back to that graph we just looked at. And you can see what $1 invested in 1926 looked like in 2021. Time in the markets, not timing of the markets. Right. So how do you buy a managed fund? How do you access them? Well, that's easy. Like I said at the beginning, it's never been easier to access investments. There's a million ways you can do it. Well, maybe not a million, but quite a few. So you can jump online and you can look at specific fund providers, and you can sign up for managed funds right there. You can use platforms that will give you options, a few options to choose from, like Sharesies or Hatch. And that would be very much a DIY strategy. But my question would be, if you're going to do that and it's a DIY strategy, how do you know if what you're looking at is the right fit for your strategy? Or worse yet, if you don't have a strategy, how do you know if it's the right one for you? They're not easy to compare, but when I am looking at managed funds, and sometimes I'm looking at managed funds for clients to see what they're already in and how they're working for them, I always like to consider what's the asset allocation. So what is the mixture of shares and bonds that they're in, or growth versus, you know, defensive? What's the geographical spread? Is it wide enough for my liking? What are the fees for that particular managed fund? And what is the performance since inception for that fund? I want to get the longest running annualized performance I can to have a look at it. And what's the overall management strategy that those particular fund managers are trying to achieve with that fund? You have to consider all of those things together to get a picture. You can't just pick one thing like performance and sort of make that your target. That's going to be your decision-making piece. When you're comparing managed funds, I think probably the most common error is not comparing like with like. So you've got to compare apples with apples. You can't compare a fund that is 80% defensive to a fund that's 80% growth. A growth fund is more than likely going to cost a little bit more, and clearly you're going to expect a difference in the returns from those funds. So there's a lot to consider when you're DIYing it. As always, the best way to start is with your end goal in mind. So in the words of Ben Graham, so Ben Graham wrote one of the most referenced books in investments called The Intelligent Investor. And he once quipped that an investor's chief problem and his worst enemy is likely to be himself. And what he means by this is that actually it's not usually the investments that we get wrong. It's what we do, us human beings, that are buying into them. And we have emotional responses to whatever kind of wind is blowing at the time. So when we're hitting more troubled times, more volatile markets, and we're watching the value of investments decrease, we tend to get a bit nervy about that, and that's going to spark a fear reaction. A natural response to fear is to decide that what was the perfect solution for your investment strategy suddenly has got too much growth exposure. So you're going to quickly see if you can decrease it and become more defensive. That is usually the worst thing to do. You'll feel like that's making you feel safer. What it's actually done is decrease your capability at that point in time to make more wealth. Ironically, when you have a good plan and it's been well considered for your timelines, often in times of volatility, the best thing to do is nothing. But that doesn't feel like an appropriate response. So the job of an advisor, apart from helping you get your plan right and helping you make sure you're working with the right assets, is to save you from yourself, is to stop you making emotionally based decisions or taking what I would describe as a wealth decreasing action. You don't have to take my word for it. There was a study done by Quantitative Analysis of Investor Behavior, 2017, where they did some research, and they found that there was a difference in outcomes for investors who did and did not use advisors, and it was 2.9% annualized. Now, over time, that kind of adds up. And I'm here to tell you that was probably most likely driven by behavior rather than necessarily investment choice. So an investment advisor, so someone like myself, we help you to sort of identify your start point. I am very focused on your end point, where it is you want to go, what you want to achieve along the way. Then we're going to consider, is there gaps? What do we need to achieve in the middle? And then we'll look to advise on the best sort of products out there, or the best managed funds that we think will help you to achieve that. And most importantly, keep you on track. That is actually probably more important than anything else. And I know when we're all sitting here calmly and we're not feeling any kind of emotion at all, we're not feeling fearful about our investments, we all think we can do it ourselves. But in fact, it really is helpful to have someone else keeping you accountable to those goals. You should think of your investment advisor as kind of like your financial trainer, because much like exercise, good outcomes and achieving the wealth outcomes you're looking for are not achieved from just some sort of occasional massive action that you take on a day that you feel good. It's from sustained, consistent action, or really just staying the course once you've got your plan in place. Before you get to an investment advisor, though, there is actually a level of work that can and should be done that actually positions you for a really good outcome from an investment advisor. Now, with Enable Me, our coaches actually work with you from right where you are today. They'll diagnose your starting point, what's going on right now. They'll identify your desired landing point and your capability to achieve it. Then they're going to design a strategy that looks at how much wealth has to be grown to help you get from the start to the end. And that's going to help to inform the decision of what asset type you should be using to do it. It could be property, it could be a managed fund, it could be a mixture of both. And once that's identified, at that point, they will refer you to an expert that will help you with that specific asset class. And if that's me, for instance, on your managed funds, I can tell you that by the time you're having a meeting with me, I know a lot about where you are based on the great work you've done with your Enable Me strategic coach. So before just deciding, do I need a mutual fund? Should I be putting any extra dollars into that? You need to know your numbers. Have you paid your mortgage off? If not, does it make sense to divert those dollars there first? Those kind of decisions will be made with your Enable Me strategic coach before deciding what extra sort of levers we're going to pull to help you achieve your goal. So what are the takeaways? Lots of Kiwis invest in KiwiSaver, but this often only contributes about 30% of what you're going to need in retirement. Managed funds are an amazing way to build diversity and liquidity into your investment strategy. And there's plenty of ways to get started, and it doesn't necessarily need to be a high value buy-in. Choosing the best plan for you will go hand in hand with getting a solid financial plan together. Now, if you would like to reach out and go have a financial consultation, now we've got a fairly snazzy scan, I'm not even sure what you call these, but if what's on your screen right now, if you put your phone on camera and point it at that, it's going to take you to the landing page you need. That's going to help you to, well, right there, you can book a consultation. Now, because you are on this webinar, you get to have that consultation at a price of $150 plus GIST. That is normally $350 plus GIST, so nice discount. But to achieve that, you've got to book it by 5 p.m. on Friday this week. You don't have to have your appointment by then, you just need to book it. For those of you, and probably like me, a bit more old school, you can see the web address on the screen. Alternatively, you can just type that into your internet. So with that, I think Charlotte has been collating some questions for me. I'll leave this on the screen for those that want to scan it for the time being. But Charlotte, have you got some questions?
Yes, thank you so much, Nikki. I found that very helpful and insightful, and I hope everyone else did. So if you have a question, you can just pop it in the Q&A box, and we'll do our very best to get through as many as possible. So Nikki, we've had some questions come throughout the course of the webinar, and we've had someone ask, should I spread my investment across multiple funds? If so, what is the most percentage I could put in each fund?
Okay. That's a good question. In terms of what percentage you should put in each fund, that is pretty difficult to answer without knowing more about your specific situation. Do you need to put, do you need to put your money in different funds? Not necessarily. Like if you've got a good diversified, managed fund and it's got the right exposure in it, for your situation to defensive assets and growth assets, and it's well diversified, geographically, you don't really need to have different funds to meet all the needs. Yeah, so I mean, some people you can, but I don't personally, because I just think if I get that right from the front end, I'm happy with that. And remember that it's not sort of set and forget. So let's just say if I decided that up to the age of mid to late 50s, I'm happy with an 80% growth exposure, but as I'm approaching that age, I might want to have slightly less growth exposure. I can simply go into the same fund and decrease it. So it's not, you don't have to have separate funds to have that level of control.
Thanks, Nikki. And we've had someone ask, do you recommend a husband and wife have their managed funds with different providers?
Depends what's motivating them to do that, really. Effectively, they could. There's no reason why you couldn't, because I guess in some ways that diversifies them further. And sometimes it's quite nice because each of you will be getting like your own reporting on those funds, and you can sit down and compare them, which can be good. Do I think it's a strictly necessary move? It's not really. That would be a preference. But again, no reason why you wouldn't. Yeah.
Thanks. And would you recommend keeping a buffer of fund and cash separate from an investment in a managed fund? If so, how much cash would you recommend keeping separate from an emergency fund?
Yeah, that's a really good question. You definitely want to have an emergency fund in the bank outside of your investments. And if you haven't generated that, you would want to before even considering investing in a managed fund, in my opinion. It achieves a couple of things. You want to have an emergency buffer in cash, just so that if something unexpected happens, you've got the money there to cover it, and you don't have to interrupt your investments to cover that expense. So it provides a level of insulation, if you like, for your managed fund. In terms of how much, that very much comes down to what your sort of running costs are, if you like. So you should have an idea of, for your household, is $5,000 a good emergency buffer, or is it 10? So again, if you work with a financial advisor, they'll help you to sort of figure that out. But as a rule, I would suggest it's probably good to have up to $5,000 saved in the bank. That's going to be left as your emergency buffer, and your investment strategies begin after that.
Thanks, Nikki. And what is the difference between investing in the share market and investing in a managed fund?
Well, managed funds are in fact invested in share markets. I think this question is perhaps more about what's the difference between just buying shares directly through something like, say, Sharesies, and a managed fund. I hope I'm interpreting that question correctly. Effectively, if you're buying individual positions, you're having to decide, on what basis you're doing that. And I would assume that you're running on some kind of strategy or not. Just randomly picking, direct positions to buy, I don't know, to me feels a bit like throwing a dart at a dartboard and not necessarily knowing what score you're trying to hit. I think that buying direct company shares directly can be fun and should be done as a sort of sideline, but not necessarily as part of what I would describe as your serious wealth building strategy. So managed funds, if you think about it, they're in the share markets too, but they tend to be market wide. So you'll get representation of a lot of the market of that particular share market. They're not sort of stock picking within it. Some do, some don't. It depends how actively managed your managed fund is. So it's a case of making sure you understand the management strategy. I feel like I'm making this answer very complicated, but there's a big difference between just buying independent positions through Sharesies and getting the sort of market-wide exposure on a share market that you get from a managed fund.
Thank you, Nikki. And is it advisable to put all my eggs in one basket, meaning be with a bank, say ANZ, with your mortgage, term deposit, and say managed funds as well?
In my opinion, No, I wouldn't do that. You could absolutely use the same bank for your mortgage and your emergency funds. I would go outside of that framework for a managed fund. Again, it's just diversification, and there's lots of reasons why I think that too. But there's so many other options outside of banks really to consider. And for that reason alone, I would shop around outside of the bank you're using for everything else.
Thanks, Nikki. And would you recommend managed funds over property investments in this current climate? And if so, why? What's your thoughts and opinions there?
No, actually. Listen, in terms of when I talk about getting a good financial plan together, part of it's going to be looking at what you're trying to achieve over what time frame, and that's going to inform what type of asset class is going to do that best for you. Could be property, could be managed funds, could be a mixture of both. So that decision isn't driven by just looking at the different asset types and just picking one randomly. You want to look at your situation, and that's going to inform which of those is going to be the best solution or the combination thereof. But interestingly, in the market where we are right now, both of them are good strategies against inflation. They have very different qualities, and that's why you'd really want to consider it within the context of your situation, which is what I would highly recommend that you talk to a financial advisor about. Both are really good investments. Yes, in the current economy we're right in, I would still say that, and for very different reasons.
Amazing, Nikki. And we've got another question saying, if you go to a managed fund provider, such as Fisher Funds, as an example, can you trust them to invest in the funds in your best interest and not their best interest?
That is a good question. That's a good question, right? When you are talking to an advisor that is directly hired by a specific fund manager, what you have to understand is that they are representing the funds of the people that have employed them. And so whatever your needs are, they're going to make sure that the solution is one of the products of the people that hire them. Now, that's not always to say that they're giving they're not giving terrible advice, and they'll have different structures and levels of growth. They'll have different options that'll suit your situation within that specific fund offering, but they're not looking beyond it. So this is my opinion, but I think the value of an advisor is in the advice that they give, and that's where it should be solely. And really, I think the indication of a good advisor is someone that has the heart of a teacher and not the heart of a salesperson. So listen, that's not to say it's a terrible option or you're going to get a terrible result, but for my money, I prefer to work with advisors that their main focus is my situation and my best outcomes, and how that feeds into the recommendations they're making, which will not necessarily be tied with one fund manager.
And Nikki, we have someone watching the webinar who's 62 years old. Is that too late to put money into a managed fund?
No, absolutely not. And I'll tell you why. I think often we think as we approach retirement, right, we're going to do all this investing in KiwiSavers and in the managed funds that we select, for instance, and we think we're going to hit the magic 65 and suddenly we're going to convert it all to cash and sit it in the bank. That is not what anyone should be doing. And in fact, we're all living longer, right? So once you hit 65, your money's still going to be working for another 25, 30 years. That is a really long investment cycle. So absolutely not. That is not too old. And no would be the short answer.
Thanks, Nikki. And if you invested in a managed fund and have no mortgage on your home, should you look to leverage off your home to purchase an investment property?
Yeah, absolutely, you could. So it's going to depend. Again, it's going to depend on different factors. And again, I would really advise going through this with one of the fabulous Enable Me strategic coaches, because it's going to be a factor. There's going to be other factors that are going to be considered. But if you don't have a mortgage on your home and you're already investing into mutual funds, you could absolutely explore what role property could play on helping you achieve your wealth targets using the leverage of your debt-free home. So yes, that could be considered, but it's definitely situational. So I would recommend that would be considered as part of your overall situation with a good financial advisor.
Perfect. Thank you, Nikki. And what is the difference between investing in the managed fund KiwiSaver and investing in other managed funds?
Sorry, was that what's the difference?
Yeah. So what's the difference kind of with investing in a KiwiSaver managed fund, whereas with kind of external to that?
Oh, so actually, KiwiSavers are managed funds, but they've got a bit of government control wrapped around them. And they've been put in place specifically, to try and encourage the population to have more funds available to them in retirement. So, I fully support what they do. So they're quite similar. I mean, here's the thing, there are lots and lots of managed funds on the market, and they're all quite different from each other. But in concept, it's sort of the same, except that you're choosing the managed fund yourself, and it doesn't have any government control around it. So it's a lot more flexible, a lot more liquid. You can use it when you want to. You're not told when you can access it, when you can't access it, or what the age of entitlement will be.
We're having some great questions come through, so we'll wrap up with a final few. So back when you were talking about the graph, Nikki, you
Yes.
said that they're good in times of rising inflation. Why is that?
To be honest, the growth exposure in managed funds is a good defensive strategy in times of inflation. So that just means to say that shares are a good defensive strategy. And of course, you're getting exposure to shares in your managed fund.
Thanks, Nikki. And term deposit laddering, what are your general thoughts on that?
Term deposit laddering?
Yes, we've had a question come through on term deposit laddering.
Okay, that's a new term on me. I assume that means when you're just using different time periods and stacking them. I don't know if the question asker is able to confirm or deny. But yeah, listen, I like that idea, but only for funds that are being held for specific use. So right now, in times of high inflation, your cash at bank is really exposed to that. Like, inflation is a silent thief. And I'll tell you what, if that was getting priced against your cash at bank every day, like managed funds are getting priced every day, you would probably find it much more shocking than you do right now. So the amount of money that you want to keep in the bank should only be as much as is needed for short-term purchases within the next 1 to 2 years, and or emergency cash buffer. Anything other than that should be working, either by reducing your mortgage faster or by being invested in a managed fund. Of that money that's sitting in the bank, if it makes sense to portion it into different time periods for term deposits that are rolling off at different times, yeah, I think it's a great strategy, because it just means you're less likely to have to break a term deposit that was one big chunk because you need one small part of it.
Thanks, Nikki. And we'll finish off with one final question. So kind of going into investments, what's a good benchmark for an initial contribution to kind of test the waters?
Into a managed fund?
Yeah, or just investing in general, kind of what's a good benchmark?
Of how much to put in to test the waters?
Yeah, that's correct.
That's an interesting question. There's no magic answer to that, because whatever you're investing in, whatever it's achieving, it's going to be the same proportionally. It's a percentage, right? So whether it's going to be a percentage of whatever you put in the beginning. I don't know necessarily that if you've selected an investment option that's in line with your overall strategy, I'm not sure why you'd be testing the waters. And actually, just in response to that question, I'm just going to flick back to that slide. Give me one moment, callers. So if we flip back to that slide, when are you testing the waters? And when are you deciding that it did well or it did badly? Is it at the bottom of one of the global events that took place, or is it at the top of one of the recoveries? How long are you testing the water for? It's not really something that I would do. I would consider the strategy. I would consider what assets I'm going to use to achieve my strategy, and then I would invest, and away I'd go. So if it's truly about testing the waters, I kind of wouldn't do it that way for these reasons. Or it could be that the question's more about, how much is appropriate to start saving into something. And that's really going to be, again, about your strategy and how much you can afford to.
Amazing, Nikki. Thank you so much for your time tonight. And thank you everyone else for joining us. I hope you found it insightful and learnt something. And if you want to come along and start making financial progress, you can scan that or head to enable.me/investing fundamentals and get you on the journey. Thanks, everyone.
Thank you so much for your time.